Hi there everyone, Greg Canavan with you on Monday the 1st of April recording this Rum Rebellion update. Today we're going to break down the Aussie market a little bit and have a look at a lot of the sectors that are performing very well and performing not so well, to give you an idea of where the money's flowing post the Fed and many other central banks around the world deciding that they're going to be on hold and creating, I guess, huge amounts of liquidity that's clearly gone into stock markets. This morning I wrote about how the March quarter for the start of 2019 was the best quarter in many years for nearly all stock markets around the world. So I thought today we could just take a step back and have a look at the Aussie market and see how the various subsectors are going there. So we'll start off with the outperforming markets or the outperforming indices, starting with gold sector. As you can see from this chart, gold's actually done quite well, probably since the end of 2018, or the Aussie gold sector, I should say. Unlike the rest of the market, Aussie gold stocks rallied towards the end of 2018, and they've really maintained that outperformance into 2019. So clearly, there's a lot of money going into Aussie gold stocks, and with the Australian dollar gold price around 18.50 an ounce, Aussie gold producers are making a lot of money. The next sector that's done really well at the start of 2019 is the information technology sector. I wrote about this at the end of last week in the Rum Rebellion. A lot of the stocks here are very, very highly priced. They're trading on price earnings ratios 50 times, 100 times, I think 200 times in the case of one of the stocks there. So quite expensive, but given that tech all around the world is very popular at the moment, probably no surprise to see that the little Aussie tech sector doing very well in addition. The next sector, no surprises here, I've covered this quite often in the Rum Rebellion updates. The materials sector, which includes a lot of the resource companies. Just last week, at the end of the quarter, broke out to another new high, and that's just really an indication that Chinese stimulus is considered, I guess, to have a bit of legs, and with the rally they're continuing, that just tells you that conditions are good for Aussie commodity producers, especially iron ore, coal, things like that. And then I think there was some data out over the weekend that showed the Chinese manufacturing sector for March expanding at its quickest pace in about 4 months. So obviously the stimulus is flowing through in China there, and that's having an effect on Aussie resource stocks. Okay, the other index, maybe surprisingly, that's broke out to a new high is the Aussie industrials. I wasn't quite sure what was driving this, and I looked into it. There's only 19 stocks in the industrials sub-index, so it doesn't take a strong performance from too many of them to, I guess, push this index higher. This index includes stocks like Brambles, Seek, Transurban, Sydney Airports, I guess a disparate bunch of stocks, but a lot of them have done quite well, and that's forced the index to rally very strongly, as you can see in 2019, and that's the rally's pushed above the 2018 peak. I guess that's just strong outperformance from a number of stocks there that have pushed on to all-time highs. I think Transurban being one of those, and that's obviously caused the sector to do quite well. Finally, this is probably no surprise given property trust. This is the property trust index. Property trusts tend to perform a bit like bonds in that when bond yields fall, bond prices rise. Same sort of thing happening here with the property index. Bond yields of the Aussie 10-year bond yield is at an all-time low, and that's pushing money to search for yield, and property trusts are obviously high yielding, so there's money flowing into the property trust to, I guess, just look for a better yield than what bonds are offering, and that's pushed this index up to beat last year's highs as well. Very strong outperformance from the property trusts there. Okay, let's look at the sectors that haven't beaten their 2018 highs. Energy, the first one here. Obviously, that's got to do with the big fall in oil prices in the latter half of 2018. Obviously, we've had a decent rebound in oil prices, but not quite as much. And oil and gas stocks are just starting to come off in the past month or so. So a bit of underperformance there from the energy stocks. Another one is healthcare. Healthcare had a very, very strong run, probably driven by CSL, which is the biggest component of the healthcare index. And that's really, you know, there's been a decent rebound in 2019, but just not as much, nowhere near the highs of 2018. The index is doing okay, looks like it's trending nicely higher, but you know, not with the impetus of some of the other sectors there. Next one, probably no surprises here, that consumer discretionary stocks are well off their 2018 highs. That's just purely related to the big drawdown in the housing prices towards the end of 2018. Once again, reasonably good rebound there, not enough to bring it back to its 2018 highs, so underperforming some of the other indices there, but still looking okay, and potentially in line for further moves to the upside. Consumer staples, look, this is mainly Woolworths and Coles, probably not doing so well as some of the others. Maybe that's got to do with these stocks maybe not being seen as defensive as they once were, exposed to the slowdown in the Aussie economy, slowdown Aussie housing market, that sort of things, but clearly the consumer staples underperforming quite strongly there as well. Next one, the banks, you know, this is once again exposed to housing prices. We've talked about banks quite a bit before. Royal Commission issues, increased competition from fintech stocks, financial technology stocks. Again, rebound's done quite well, but nowhere near the highs. And really the highs of 2018, they didn't beat the highs of 2017. And I think this whole sector probably peaked back in 2016, it might have been. So we're looking at a pretty long-term downtrend for the banks there. Last chart I've got, I think it's the last chart for today, is the small ords. I threw this one in because just to sort of show the strength of the rebound in 2019, but also the fact that it came up against resistance that I've drawn that line against there and come back down quite sharply. Whether the I guess the liquidity from global central banks and the propensity to ease from the RBA will see that index break through that resistance in the weeks ahead. Not too sure, but just goes to show that there is still a little bit of concern about stocks moving back to their old highs and breaking higher. All right, I'll leave it there for today. I guess the main takeaway is that anything related to China or falling bond yields is doing quite well. Anything related to the Aussie domestic economy is underperforming relative to those other sectors. All right, I'll leave it there and catch you again next week.
Yeah.
Cool. Sorry. That's all right, no worries.
Thank you.
Let's see.